This is Larry Gonzales, branch leader of the broker in Hawaii, and I'm here to talk to you today about our 2024 forecast in Hawaii, specifically across the country, but specifically on point in Hawaii. And really, this year, more so than any other year, it's gonna be about supply and demand in the number of homes on the market. We'll get kind of in. So right out the gate, bottom line up front, the bluff. Prices this year, I expect prices to go up. We'll get into that. Inventory, I think inventory is going to go down ultimately. And rates, I think they're going to go down too. And the reason I don't have a straight line down is because it's not going to be a straight line down. There is resistance to interest rates going down that we are going to encounter throughout the year. And these things that are slowing or the resistance that we are seeing is going to be the Fed, it's going to be inflation, it's going to be jobs, it's going to be world events. There's a lot of things that are going to try and hold interest rates where they're at or push them higher. But overall, you're going to see a trajectory in the downward direction for rates this year. Let's talk about inflation. We've been talking about inflation for well over a year and a half now. Interest rates went up really at the end of 2022, and that's kind of what we've had to deal with trying to get inflation down, and we just haven't been able to do it, but we've made incredible progress. All right, the Fed goal is to get to 2% PCE, core PCE. So PCE is personal consumption expenditure report. That's their inflation report that they prefer. It usually comes out at the end of the month. Right now, we're at 3.16%. So we're close to being at, into the two handles, but we're not there yet. At the peak, we were up at like 6.6%. So they've come down a lot. And the expectation is that we are going to continue to see PCE, core PCE come down. And the reason why is because every month when the report comes out, it's replacing last year's reading. And the difference is right in the first 3 months of the year are pretty substantial. And the expectation is that we will increase inflation by 0.1%, but it's replacing 0.39%. So really the core, if all checks out, will come down to 2.87 in January. The Fed President Powell said that he was going to not wait for inflation to get down to 2% to start dropping the Fed funds rate, but once they got to around 3% or below 3%, they would look at that. So if the January reading, which comes out on the 26th of January, comes in core at 2.87, well, okay, that might be a good reason for them, the Fed, to lower the Fed funds rate. But really, that's so close. What if it's a one-off? So it's not likely that at their January 31st Fed meeting that they are going to reduce the Fed funds rate. All right. Now their next meeting is going to be in March. And the January reading for the January 2024 reading, which will come out in the end of February, we might see if inflation comes down the way we expect it to, we might see near 2.5%. Well, that is actually probably a good reason for the Fed then at the March meeting to go ahead and reduce the Fed funds rate. No guarantee, but that is a possibility. And then as you see, February's reading will come out after the March meeting. So they are going to base their decision to lower the Fed funds rate off of what they see the January reading of possibly 2.47. So as you can see, the expectation really is that core PCE by September should be down below 2%, which coincidentally is where we were at before COVID pandemic or pre-COVID. So now, just like, there are odds that we bet on football games. I know a lot of people lost money on the Cowboys-Packers game this weekend. But because people who make the odds, sometimes they're wrong. But the odds are the market experts are predicting when the Fed is going to cut the Fed funds rate. And right now, 7% think that they're going to do it at the January meeting. 68% think that they will do a cut at the March meeting and 94% at the May meeting. And then every meeting thereafter, they think that Fed is going to cut the Fed funds rate. Now, and I've seen people say, hey, there's we're going to do 6 Fed funds future cuts this year. That's asking a lot. That is wishful thinking, all right? I don't think that's going to happen. And really, the Fed is in no hurry. They're in no hurry to lower the Fed's fund rate by more than 75 basis points this year, probably. Maybe they do one in March, but it's more realistically they wait and see how things kind of clear out through May and do their first Fed cut in May, and that's what I think will happen. I think they're skittish to make that move in March. And what is the impact on that, guys? Hey, that means the Fed funds rate comes down. While it's not directly correlated to mortgage rates, they will come down too. All right. And the expectation of one every time they meet for the rest of the year is not realistic. But they definitely think by the June meeting, 91, almost 100% think we'll be at least a 50% drop in the Fed funds rate by the June meeting. All right, so again, hey, a lot of people picked the Cowboys and they didn't beat the Packers, so the experts are sometimes wrong. Here's kind of what the Fed is thinking, and this is the dot plot, and this comes out after every one of their meetings, and they kind of indicate where they think the Fed funds rate is going to be at during the course of the year, at the end of the year. And for 2024, at this last meeting, there were 2 members of the Federal Reserve Board who said no, 0 cuts. They expect 0 cuts, but a majority think you're going to see a 50 to 100 basis point decrease in the Fed funds rate. 100 basis points, that's 1%. If we had a drop of 1% in rates, I tell you what does that mean? Well, that means you got 5 million more buyers coming into the market, for one. 2025, the expectation is another 100 basis points drop, at least. That'll get you down into the mid threes for the Fed funds rate. And if we drop another percent in interest rates, and they don't necessarily directly correlate, but if we dropped another point for interest rates, that would be another 5 million people who are entering or are now able to buy a home. And then you see by end of 2026, the Fed funds rate is back to 2.5%, not quite at 0, which is where we were at for much of that time after the Great Recession. But what this shows is, hey, if you buy a house now, there's a really good chance that you're going to be able to refinance, drop a point, maybe even 2 points within the next 2 to 3 years. And every house I bought, folks, every single house I bought, I've refinanced and lowered my rate. And while I may have been at the top of my limit when I bought the house, or maybe even above my budget, within a year, I was in my budget. And then I was really in my budget that second time I refinanced. So the opportunity, if you buy a home now, the opportunity to refinance is going to be there over the course of the next year to 2 years, even 3 years. That's what this chart is saying. And the Fed fully believes that they are going to lower the Fed funds rate this year. Now, this changes every month. So next month it will be completely different. But right now, they are in line overall with the Fed funds rate coming down by at least 3 points. So let's look at initial jobless claims. So why am I looking at initial jobless claims? Well, this is the one thing that the Fed controls inflation and they control unemployment. Or they don't control unemployment, but they try and manage it. They manage it truly by increasing the Fed funds rate. When it's high, it makes it very difficult to hire new people, and the labor market typically becomes restricted. But our economy has been so strong. This is over the course of this year, we have flatlined with initial jobless claims, and we have not really cracked above 210, 220,000 people applying a week for unemployment. We need to see this number go up above 300,000 a week for the Fed to feel comfortable. And more importantly, continuing claims. There are not even 2 million people who are continue to receive over the course of time unemployment because they can't get hired. All right. So, because the problem is there are over 8 million jobs available and there are less than 2 million people who are unemployed and looking for a job. If you want a job, you can find it. And you know what? They want income. They want a job. And they're going out and getting jobs. Some people are getting 2 or 3 jobs. All right. But there just isn't high unemployment. One of the reasons why there isn't high unemployment is because employers are already shortchanged. You go at any business out there and everybody's looking for people. All right. The Fed wants unemployment to go up, not out of control up, because if it goes out of control up, then we will definitely go into a recession. But they want unemployment to go up because that will help with inflation coming down. All right, so harder to get a job once you lose it, but really, if you want a job, you can find it because there are 8 million jobs and there are only 2 million, not even 2 million people looking. In order for the Fed to really say, you know what, we are going to start cutting the Fed funds rate, they're going to need to see these jobless claims, continuing claims go above 2.5 million up to 3 million. And right now, I don't see it. But if you remember last year, right after Christmas or right at the New Year, you had Amazon laying off 100,000 people. You had Google laying off 100,000 people. You had a lot of people getting laid off. Facebook led the charge with laying people off. So, expect, as inflation isn't where we need it, and the Fed funds rate hasn't moved yet. Expect large employers especially, to start laying off some people in this first quarter of 2024. And why is this a big deal? Because when inflation goes up, unemployment goes up as typically as well. I mean, you can see that on this chart. These gray bands are when we had recessions, and we'll get into that. One, when unemployment hits the bottom, all right, its lowest level, typically unemployment hits the lowest level, we go in a recession, all right? 2008, unemployment hit the lowest level, it went up, and we shortly went into a recession, and unemployment went up even more. Unemployment in 2000, after 2000, we hit a bottom here right around 4%, and then we shot up into recession. All right, same thing back in the mid 1992, and certainly throughout the 80s, you saw unemployment going up as we went through just a tough time in the 80s, the beginning of the 80s with the recession. Unemployment went up, but what happened to inflation? Inflation went down. Inflation went down. Inflation went down. 2008, inflation went down. Down. All right, and then it started to come up, but it was still pretty darn low. And let's look at this. Right now, unemployment is historical as it has not been. This is the dark red line. Unemployment has not been as low as it is since before I was born. All right, in the mid 60s, it was this low. Our unemployment is super low, and we just haven't come off that bottom yet. We're stagnated on the bottom. And so the Fed, that's one of the Fed's concerns. So they're controlling unemployment, but they're not really controlling unemployment. The economy is controlling the unemployment. They are controlling inflation, and they're getting inflation back down. In a recession, typically inflation drops. So if we go into a recession, which the Fed doesn't want, you would see inflation drop even more. I've been saying we're going to go into a recession for the last couple of years, and we just haven't done it, largely because unemployment has not increased to that level. Going against the curve here, all right? Inflation's going down, inflation's staying down. Can we have that? And if unemployment goes up, will inflation still go down, or will inflation go up as well? That's something that remains to be seen, but that's one of the things the Fed is looking at, because the Fed does not want us to go in a recession. And the Fed says the economy is solid. It absolutely is. GDP is strong. Unemployment's below 4%. Our core PC, it's yellow because it's not where they want at 2%, but it's way lower than it was. And we should be in the 2 handles here by the January, when the January report comes out in February, if we aren't already there next week. Now, there is some data that suggests otherwise. Obviously, we've been talking about an inverted yield curve for the last couple years, but when you're in an inverted yield curve, that doesn't mean the recession is going to happen right away. It could be 36 months later. So it's just something to watch out for. I'm not a person to make a decision based on one data point, and nor should you. There's a lot of other things. Unemployment bottoms. If unemployment starts going up, there's a good chance we're going to go in a recession, and that's what the Fed is looking at. 2 quarters of GDP negative. Hey, we haven't had that. So that's in green. 10-year Treasury bill above 4%. Dude, we got to 5% at the end of the year. Now we're back near 4%. We've been teetering along that. But it's red right now, but it really could be yellow. And then oil at $100 a barrel, with what's going on in the Middle East and the Red Sea, even where we're at right now, oil prices are in the mid 70s, the low 70s. But this could turn red. And I think if we get, 4 of these 5 things in the red, we're definitely going in a recession. But the Fed is trying to fight that. The Fed doesn't control some of this, though, okay? All right, so let's look at mortgage rates declining during a recession. I want to talk about this, not a lot, but just to show you, mortgage rate. We already said inflation goes down during a recession. Well, guess what? Mortgage rates go down, too. All right, you look at 2020. Woo-wee! I tell you what, mortgage rates went down big time. All right, and we're still recovering from that. And you see how high they went up. 2008, when we were in the recession, mortgage rates came down. I had an adjustable rate mortgage. And then 2008, 2009 happened, and when my arm went out, my new loan was lower than what it was with an arm even. So I don't expect that to happen, people, but that's just another example. Every time we've had a recession, you see interest rates, mortgage rates going down. So I don't want to spend a lot of time on that, but if we go in a recession, not that everyone's rooting for it, I certainly am not, but it usually is a good story for mortgage rates. Now, let's talk about the 10-year Treasury and the 30-year split. Historically, if you look right here, we are between 1.5% to 2% difference, all right, in the 10-year Treasury and the 30-year mortgage. However, we are near a 3% split. So if the 10-year Treasury is at 4%, we are closer to 7%. This is conventional rates, 7% on conventional rates, whereas we should be near 6%. So as that delta becomes lower and maybe comes back to where this channel was here between 2009 and certainly 2020, all right, we will see interest rates come down, but we haven't seen that yet. A lot of it has to do with the Fed spending and how much money that they are putting into the economy. They've been holding off, and once they stop their tightening, where they don't buy any more treasuries and securities, mortgage-backed securities, then once they stop that tightening, we might see this come down more, but they haven't done that yet, and they haven't really given us an indication on when that's going to happen, but possibly this year. But if we get that delta, you'll see interest rates come down a lot quicker. All right, rate impact on inventory. This is super important here because we are in a volatile market, and you're going to see that the movement of interest rates is going to have a big impact on inventory. As interest rates go down, which is represented by the green blocks, what happens to inventory? Inventory goes down. Huge thing to remember. When interest rates go up, inventory typically goes up. And you could see this throughout. And then we get into COVID, interest rates drop. Look at the big drop in inventory, though. This was pretty big. Now inventory dropped by over half the amount of inventory we had prior to going into COVID. And we have not recovered. So interest rates went down until the end of 2021, and they started to go up, right? They started to go up, and by the end of 2022, we kind of had peaked at interest rates. Inventory started going up, and that was good, all right? And then at the beginning of the year, 2023, interest rates went down. We were in the mid-5. I was talking guys in the mid-low 5s at that time on VA. Inventory went down. Interest rates went up. I mean, the highest that we've seen them, right? Over 8%. Inventory went up, but it didn't go up as much as it did, or as steeply as it did when interest rates initially started going up in 2022. So we never really got that big boost of inventory when the rates went sky high. And they did go up in the last couple months, but because rates got so high, what did we not have? We did not have new listings, and I'll get into that. That is important, and here's the impact. Right now, we are at half the amount of inventory that we had going into COVID, right? So people would think that we're going to go right back to the way it was before COVID. No, because we have half as many homes that are currently available to be bought. All right, the inventory is existing home sales and new home sales. All right, so let's look at the real estate forecast as far as inventory goes. We have had certainly the builders. Inventory remains like builders have not built as many homes. They don't want to get to the point where we were in the housing crisis when they just were overshooting on their building. They were, for every home, there was a quarter of a buyer or an eighth of a buyer. Now it's for every home, there's 4 or 5 buyers, and they like that. That's good. That's profitable for them. So they are not going to overbuild. And besides, with high rates, everything goes up with high rates and high inflation. It's more expensive for supplies. It's more expensive for people. So they're not going to overextend themselves. And inventory in 2023, it did go up, but that was because we hit almost an all-time low for housing inventory in 2022. It went up, but not that much. And here's where that impact is, folks. Formations, people coming into the market. 2 million people came in the market in 2023. Expect the same thing in 2024. This delta here, we're not going to make up. We can't make that up. There will be a housing shortage as long as, really probably for the next decade, maybe even longer, because there just aren't enough homes on the market for the people who are coming into the market or are coming of age to buy. All right, there every year. for the next probably 5 to 10 years, you're going to see almost 4 million new people who are of that age, that typical age, average age when they can buy a home. So that's something to keep an eye on. But because of this right here, more people, less completions, we're going to see this big delta, I think, and inventory is not going to go sky high, and we're not going to be where we need. Now let's look locally, all right? Because hey, it's all about location, 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 right? Well, this is Oahu. All right, Honolulu Board of Realtors reports for December end of year. At the end of the year, so this is pretty normal, right? At the end of the year, typically the active inventory goes down. There's less people putting their homes on the market. We see that here. We saw that in 2022. We saw that in 2021. Inventory went down. Now, typically, again, inventory goes up when rates go up. Well, inventory went up all of 2022 because rates started going up really at the beginning of 2022. Not a lot until the end of the year when they spiked. And then typically you would think, all right, interest rates will continue to go up. But rates came down at the beginning of the year, if you remember. So the inventory dropped for both single family homes, which is green, and for condos. Right? So inventory went down despite interest rates still staying elevated. We're in the 6 and 7%. And you know what happened? Well, at the end of 2022 or 2022, that was shock. The market was in shock, all right? Hadn't seen those high rates since really 2018 when we were in the mid fives. So the market was in shock. But then there's kind of like well, I guess we're kind of used to this. We got to buy. A roof over our head, we're going to buy. And that's why you see inventory going down, even though rates were in the 6s and the 7%. And then when they got into the 8 in November, well, then we saw inventory start to shoot up. But still, December, inventory went down. Rates are still high. They were coming down off the 8% high, but we're kind of seeing what we saw last year. All right, they peak in November, December timeframe, and then they start to go down. If it goes down anymore, it is going to be a very, very difficult market. All right, you have lower inventory plus lower interest rates equals a competitive and unhealthy market, especially locally in Oahu. All right, new listings. All right, this here was this is from the December report. New listings, scary drop in new listings. It always happens, folks. Drop in new listings in 2022. Drop in new listings in 2021 at the end of the year. This was a pretty big drop in new listings, certainly in 2021. But you look at the last 3 months. All right, we're not even where the dip, the bottom of the dip from 2021. We're below that. And you see how drastic that drop is in new listings at the end of the year, which is, for those of us in the military, that's that PCS part 2, right? Not a lot of new listings. That's not a lot of momentum going into the new year. Big concern I have locally in Oahu. And nationally, I was just watching a report on another website. They were talking about, hey, looks like we have a lot of new inventory. It's looking good starting in 2024. I'm not seeing that here yet. I'm not seeing that here, and that has me concerned. All right, let's look at closed sales. All right, 2021 and 20. This is for the last. I don't know. I can't even see the numbers so small. This is a long time. This is for before I was born. All right, so that's a long time, right? All right. The historical closed sales. Green is single family homes, and gold is condos. If you look at the trajectory, we were on a nice post. This year was a Great Recession right in the middle. All right, but if you look post-Great Recession, you saw a steady rise in closed sales. All right, a little bit of a spike for single-family homes. That's a healthy rise. And then we had a big drop in closed sales in 2022 just because there just was no inventory. Rates were high, and that was obviously an impact, but a big drop in closed sales for both condos in the gold, and single-family homes in the green. If you think we're going to go back to the way it was before COVID, before 2021 or 2023, or even back to where it was in 21, 22, you're going to need to double the amount of inventory that we have for single family homes and nearly triple the amount of inventory to reach that same amount of closed sales for condos. Folks, I just don't see that happening. Yes, with rates coming down, you got people who have that mortgage lock there. They don't want to sell because they can't afford to buy anywhere else. They're going to start to sell. You're going to see those come on the market. That's great. That's healthy. We need that. But you're not going to see enough of that happen. And there aren't enough new homes being built, completed, to meet the need for us to get the inventory back up so that we are on track with where we were historically before COVID. All right, so this here is a big concern really for every one of us, whether you're a realtor, whether you're a lender, whether you're a buyer, and even if you're a seller, this is good for you because with the fewer closed sales, that means lower supply, and that means more demand for you, especially when rates go down. Let's look at the median sales price. A couple things. One, short-term home ownership, super risky, super risky. Long-term home ownership, though, you look at this, you got a steady rate of appreciation as a homeowner, whether it be condos or single-family homes. And we are, despite interest rates being as high as they have been, condos is steady Eddie. Hey, you know what? We're still charging ahead. We're 500,000. We'll go up this year. Single-family homes, we popped. Look at that. Right after COVID, we popped into the $1 million range. Now, the days of median sales price being below 1 million, man, that train has left the station, people. We ain't going back there. We may have a month here, dip here and there, but expect the rate of appreciation and the median sales price, which is two different things, but expect the median sales price to continue to go up. We're going to stay above 1 million. And with rates coming down, all right, and low inventory, I think if you buy a home and it's at 1 million, you're going to get over the course of the next 2 to 3 years, $300,000 to $400,000 in appreciation. There's just not a lot of inventory. And if you just carry this curve, all right, this historical curve for the median sales price going up, all right, and you apply that at the $1 million mark from 2021, you're going to see pretty healthy. Take that out here. You're going to see pretty healthy rate of appreciation for single family homes. If you can afford that $1 million home, I'm telling you, I'd be buying it. In the condos, just expect steady Eddie appreciation, 5 to 6% a year. That's solid, folks. That's a great investment. This consistency, and why are we going to see this? You're going to this consistent low inventory plus lower interest rates. You're going to see the median sales price continue to go up. You know, my hometown in San Jose, in 2016, it became the first metropolitan area to have a median sales price above 1 million. And the thought was 2023 we'd get to 1 million. We got there about 2 years before that. But San Jose, I don't know where they're at, but they're got to be around 1.5, 1.6 million median sales price right now. And they may go down because they have what we don't have. They have a land and they can expand. They have suburbs. We have the ocean. So I don't see us going down. They went down a little bit during this last year, but they're coming back strong too. Hawaii median sales price, expect that to go up, continue to go up as we go through 2024, especially we get into that PCS, that prime spring and summer moving season, folks. All right, so let's look at affordability. Hey, fact, it is not as affordable to buy a home now as it was before COVID. 100% agree. I'm not going to tell you something different, but it's not as bad as the media claims it to be. Let's look at this scenario right here. All right, so buying a $240,000 mortgage, $300,000 home, $240,000 mortgage. You're more at 2.875 in 2021. Your monthly payment was $1,000 roughly. All right, your monthly income needed to buy this home was about $4,000. Today, that same loan is going to be about $280,000 due to appreciation. Interest rate around 6.625. All right, so the new price is $1,800. That new mortgage payment is $1,800. That's an 80% increase in a mortgage payment. Hey, that's a lot. I know it. I know affordability. It's real, or unaffordability. It's real. But let's look at monthly income. In order to get that difference of $800, you would need a 20% increase in your income. Well, folks, incomes have risen 15% since 2021. This isn't me making this up. This is ADP. They do their employment reports. They track all of that every year. They track income growth. But income has risen 15% since 2021. So that affordability isn't as bad as it seems because people's pay has gone up. So that is something to consider when people say, oh, it's too affordable. You know what? For some people it is. For some people it's a cop-out. For some people they just don't know and they're afraid to ask. And that's where people like me come in to show you that you can do it. Or maybe you adjust your budget. And that's the important thing this year. Everyone who's afraid to buy, hey, just find out what the budget is. You may be surprised, especially in Hawaii. All right, so what's my rate forecast for the year? Well, 30-year fixed rate. This is conventional. All right, Everyone, I've seen everything from I've even seen 8%, going back up to 8%. I don't think we're going to go up. I think we're not going to go straight down. I think we're in the basically right around 7% right now, conventional. After a few of the things that went on this week with retail sales and whatnot, but I think by the end of the year we should be in the mid sixes, maybe even into the fives. But again, there's a lot of different things that are going to be at play. But if we get under 6% for conventional, so you're looking at under 5.5% for VA, expect more buyers are going to start. They're going to start or move up. You're going to see people selling their homes so they can buy it because now they can afford to. 10-year Treasury, again, they are not directly related, but they do move in tandem. They dance together. Right now, they're like this. They're not very close to each other. They may get a little closer. That would be good for us. And we may see a more normal spread. We're at 4% right now, just over 4%. As I'm talking, we were surprised. Everyone was surprised when it went up to 5%. Everyone was holding their breath. They're just like, when is this going to stop? We expect to be in the threes this year, maybe even the low threes with the 10-year Treasury. A lot of it depends, though, when the Fed starts lowering their Fed funds rate. We may see it sooner if they lower the Fed funds rate in March. Realistically, expect to get into the mid threes probably the summertime going into the fall. All right, folks. So what does this mean for you? All right, whether you're a realtor, you're a buyer, you're a lender. Hey, first things first, you don't control the market. I went over a lot of stuff. You don't control any of that. I don't control any of that. I don't. I'm not going to control inflation. Not me personally. No, I'm just going to report it. I'm going to look at it. I'm going to review it every day. I'm going to look at housing. I'm going to look at jobs. I don't control it, though. I don't get stressed out because I don't control it. All right. What you can control are the actions you take to gain control of the market if you're a realtor. There's a lot of realtors who are so excited about 2024, but are they doing the things that they need to do to be successful in 2024? Or are they waiting for the leads to come in, waiting for the listings to happen? Man, that ain't going to happen. You know who's going to get those listings? The people who are taking action now. All right, they're reaching out. They're in cahoots with their past clients, and they're ready, and they're asking for more business. Those are the people who are going to do well. And there are a lot of people who left the industry, both as a lender, both as a realtor, and as home buyers. They've left. They're done. But there's still some who are hanging on. If you want to be successful, take action on the things that you can control. All right, stay persistent and positive, the two P's. Hey, you know what? As the market gets tighter, as rates go down, you're going to see a competitive market. That's where working hand in hand with your lender, realtor partner, that's where you're going to win business for your clients. You're going to win the home for your clients. You're going to get the best price for your clients when they sell. All right. But you got to stay persistent and you got to stay positive. I'm telling you right now, it's not going to be an easy market. I'm positive of that. But I'm more positive that I'm going to do the things that I'm going to need to make my company successful and my client successful. My client, whether my client's a buyer or a realtor. All right. Key here is take action. Don't wait. Take action. I just saw a quote today. Champions, they don't show up to practice late. They're not waiting for the coach to call off practice so they can go hit the shower. All right. The champions, they get there early. They don't need a reminder. The champions stay late. All right. If you want to be a champion is owning a home. Champion is being a successful realtor. Champion is being a successful lender. Take action. Don't wait. Take action. And my friends, you will be successful in 2024. That's my market forecast. God bless you all. Have a great new year. And just know I am always here for you. Counsel, help you buy a home, sell a home, help you grow your business. That's what I'm here for. All right. Aloha.